Good afternoon to you. Good afternoon, everybody. Our pleasure to be here for our series in our series of BTRM webinars. And today we're going to have a conversation with between myself and my faculty colleague, Mr. Kevin Liddy. I will allow him to introduce himself in a second. Before we do, just a quick bit of housekeeping or background. First of all, as you've just heard, this is a conversation, not a presentation, so we won't be sharing any slides. For those of you who are interested in the BTRM itself, the program, we do have an information session later on this week. There's one this Thursday, an BTRM information session, and there's another one again, I believe next Wednesday, on a different set later on in the UK time for those of us in an earlier time zone than the UK. So we do have straightforward information sessions on the BTRM. We do have a forthcoming webinar on counterparty credit risk management and collateral management in the new year. This one is going to be about the replacement reference rates for US dollar and Great British Pounds, GBP. US dollar and GBP replacement reference rates, which was, of course, as Ed just said, SOFR, Secured Overnight Financing Rate or Funding Rate, SOFR, which when you pronounce it sounds like SOFA, and SONIA, Sterling Overnight Index Average. Now, the conversation today was put together because quite frequently on the BTRM, the faculty get asked questions about how these reference rates work in practice, both in the customer market when floating rate loans are set with this linkage, explicit linkage to this new reference rate, either SONIA or SOFR, and also in the interbank market and the derivatives market, how exactly it works. So you would have seen from the blurb on today's webinar what we're going to be talking about. And hopefully we'll get the answers to those questions from my esteemed colleague, Mr. Liddy. And at the end of the conversation, after 35 minutes or so, we will open up the webinar to any comments or questions that any of you have. So for the time being, you are all muted. But once we get to the conversation part, the Q&A part, you will have an option to unmute yourself and ask a question, or if you wish, write something into the chat box. Now, if you have any questions in the meantime, while we're having the muted part of the session, the conversation between Kevin and myself, simply write your comment or question or observation or challenge into the chat box, and I will be keeping an eye on them, and we'll go through those as well at the end. So there'll be plenty of time for Q&A at the end of this conversation. Right, before I proceed though, let me just allow my friend and colleague from the BTRM faculty, actually work colleague as well from our days at Royal Bank of Scotland, which is getting on for some years ago now. You may have noticed, some of you, that the BTRM faculty does have a disproportionate number of what I call the RBS diaspora, the ex-RBS people that I personally happen to work with, and enjoyed that so much that I had to carry on working with them by roping them into the faculty. Kevin is one of those. Mr. Liv, just a few words of introduction, yourself, where you are, and then we'll get on to the conversation. And thank you for joining us.
It's all right. Thank you. So Kevin Liddy, faculty BTRM member. I had a 30-year career in banking, mainly on the trading side, through a various selection of banks, but I ended up being the head of short-term interest rate trading globally for RBS by the time I left there in 2013. I was also head of the XVA desk, or CVA desk, some of you may know about that, or Counterparty risk management, by the time I left as well, and I've continued consulting in that field since then. Well, that's me. So Moorad, ask me your question.
Right, excellent, thank you. Okay, I'm gonna stick to the script actually. So okay. By that I mean, first of all, we've got a wide variation in backgrounds amongst the people who join these webinars. So first of all, we're looking specifically at, well, we're looking just at SOFR and SONIA, okay, for the purposes of this conversation. So just to make sure everyone's all on the same page, we're all very familiar with LIBOR, late and lamented, if I'm going to give a personal opinion. The late and lamented LIBOR, we're very familiar with the way that worked, and not just how it was set, I mean, that was part of the controversy around it, but also how it worked in practice for both derivatives and cash products. Just to make sure everyone's on the same page, the new rates, the overnight rates, SONIA and SOFR, they work differently. So could you just explain, and assume I'm a beginner as well for the purpose of this conversation, so assume I have no previous knowledge. Just explain exactly the meaning of a backward-looking interest rate. In other words, how do these rates work in practice? If I set an interest rate and I want to know how much I'm going to pay or receive in interest, how do these two work in practice? And assume I don't know anything.
Okay. I think in order to answer your question, I think it's always worthwhile if we take a step back and we actually look. I mean, you say people know what LIBOR is, and fine, that's okay. But if we take a step back and actually look at what LIBOR was, and how it evolved and what it became and why it became the one rate to rule them all, as I'd like to call it, we can then sort of get a perspective as to what the problems were and why it had to be replaced, and then why the RFRs or the ARRs or alternative reference rates were chosen, and why the RFR became the one that that is most going to be most widely used going forward. So let's take a step back and let's look at the picture. So until the 1980s, floating cash rate instruments were indexed to a whole variety of indices, prime, base, or whatever the official policy rate in any particular currency was. And tools to manage the interest rate risk were fairly limited. Maturity mismatches were managed with, cash-based products, and they were very capital intensive because they were on balance sheet. And you basically only had fixed rate loans and deposits, right, that you could play with to give yourself some sort of interest rate gap. And that all changed with the introduction of derivatives. Now, derivatives had no principal exchange, therefore off balance sheet, and they're much more capital efficient. They attract virtually no capital whatsoever. And so you now had a situation where you could quite easily swap fixed rate cash flows for variable rate cash flows. But in order to do that, you needed a standardized variable rate index on which to set your variable rate or your reference rate or your floating rate, whatever you want to call it. So the development of LIBOR was a standardized index.
I prefer floating, but
floating, floating, yeah. So the development of LIBOR as a standardized index was used to calculate these floating rate cash flows. And this led to the exponential growth of the derivative market and provided all the hedging tools you could possibly imagine to manage interest rate risk on your balance sheet, or corporates or banks or anyone. But the problem was LIBOR was essentially a snapshot where banks would lend to each other in a variety of tenors out to 1 year. And knowing today's LIBOR, and you could see observable products that would tell you where LIBOR would be at some stage in the future, you could sort of build a yield curve of market expectations of where LIBOR is going to be. And because the LIBOR itself was an interbank transaction, it included some element of interbank credit. And in a normal situation, interbank credit would trade at a higher rate than government credit. So you could extend your observable swap curve with reference to the underlying government bond market by applying a spread to the government bond market. So all of a sudden, we've got a curve that goes out, a LIBOR-based curve that goes out as long as the government bond market, and in some weird ways, people like to extrapolate beyond the end of that, and we ended up with 100-year swaps, but, that's another story. But with derivative market makers willing to temporarily warehouse the spread risk between, LIBOR-based derivatives and government bond markets and basically trade that spread, the derivative market actually became more liquid than the underlying government bond market, like in both the US and the UK, and probably everywhere else as well. And so all of a sudden we had these tools at our disposal where fixed rate loans and mortgages, fixed rate loans could be done, and fixed rate mortgages could come into existence, fixed rate bond issuance that matched investor demand with a floating rate liability for the issuer, and all tools for the ALM desks up and down the country, up and down the world, arrived, where we could turn up the dial of fixed versus floating ratios on any balance sheet, corporate, bank, whatever. But the trillions and trillions and trillions of dollar cash and derivative products that were based on LIBOR were now completely dependent on an index that was determined, or a floating rate reference rate index that was determined by where the banks lent to each other in the interbank cash market. And as we know, interbank cash, is capital intensive. It's on balance sheet, and so interbank lending had already, reduced in terms of volume because of the capital constraints that the banks had. And then post the 2008 financial crisis, even less interbank cash happened because banks were much more concerned about counterparty credit risk, so they didn't do any interbank lending. So in effect, LIBOR, which was so-called the most important number in the markets, became a constructed index or floating rate that wasn't actually supported by real transactions, was reliant on expert judgment from the submitters. It was prone to adverse selection or manipulation, shall we call it, and it failed all the regulatory sniff tests, so it had to go. It had to go, and that was the view of the regulators globally. So developing the alternative reference rates, or ARRs, and phasing out LIBOR and other LIBOR-like indices became a regulatory objective. And one of the most important stipulations for a new reference rate was it had to be based on a deep volume of underlying transactions. And the most heavily traded and the most liquid market in cash that you can find is the overnight market. And the overnight market, it's almost deemed to have no interest rate risk, especially if you've secured it against a repo, secured it in the form of an overnight repo, which is what SOFR actually is. But it became obvious that overnight rates were the closest thing you were going to get to having something that was reliably going to be based for the foreseeable future on actual transactions in the overnight market. And so the ARRs became the RFRs, or the risk-free rate. I don't know quite when that happened, but the term ARR was almost like retired, and now we now start talking about RFRs, or risk-free rates. Confusingly, we also call them OISs, but we'll come to that bit in a minute. So each jurisdiction then developed its own RFR, and we have a whole series of them. I know we're going to concentrate on SOFR and SONIA, but I think we have Esther, Toner, Cora, Sora, and my own personal favorite, Thor. Which is the Thai overnight rate.
I didn't know that one. Is
that's my favourite.
But it shouldn't be the Thai one. It should be some Scandinavian rate, surely. That's sorry.
No, it's Thai overnight rate. Thor. So it's.
They should pay Chris Hemsworth to advertise that one. Sorry, no, carry on.
But then let's consider, so we now have this like smorgasbord of each individual jurisdiction has its own overnight index, its own RFR, and they're pushing their own transition away from their LIBOR or LIBOR-like index to these RFRs. But let's just consider the difference between a simple 2-year interest rate swap versus 3-month LIBOR and one against an RFR.
But before we do,
this gets you to your backward bit, right?
No, actually, no, yes, absolutely no. But I appreciate that background because that was very relevant, because you explained why it went, and then you said it had to go, but Euribor has been retained.
Right.
Now Euribor, I want to get to the backward-looking bit, because the questions I get asked often is, I'm about to take out a loan and I want it to be floating rate, so the bank has linked it to SONIA or SOFR. Or I'm doing the hedge with the swap and I pay or receive fixed to receive or pay floating, and that's a 3-month coupon linked to SONIA or SOFR. And the question is, because it's backward-looking, it's daily accrued, and until the day before the coupon payment, I don't actually know what the final interest. I can make a good estimate, but I don't know what the final interest amount is going to be until the day before. Although I can make a good estimate because what additional overnight are you going to get?
No, that's where we're getting to next.
Right. Okay. Perfect. But absolutely, that's perfect. But I wanted to, when you say it had to go, yes, that I understand. But it could have been turned into, I mean, Euribor is good to go. It still fills all the regulatory requirements. And that's a rate where if I look at today's fix, actually, I'd be interested in your comment on what I just said, actually.
Yeah.
But I look at today's fix and I look at the 3-month Euribor, it says, what have you, 1.5% or whatever it says. And so I know that if I'm paying somebody interest or receiving interest for the next 3 months, it's 1.5% times the notional, times the day rate count, the day count, the interest amount. And so I know explicitly what it is today. That's very easy to use. And more to the point, it's very easy to explain. Okay, so Euribor was made good. Now, before we get to the mechanics of the RFRs, just for interest, just explore why, when you say it had to go, why couldn't it have been, to use an expression, Euriborified? Why couldn't it have been made okay in the way that Euribor has?
Okay, so when I said LIBOR had to go, right? There were a lot of LIBOR-like indices around the world. Every single index, including LIBOR, went through a period of review to see if it could be remediated in order to satisfy the benchmark requirements that had been laid out by the Financial Stability Board. In the case of Euribor, it was deemed that it could be remediated in such a way that it would be representative of an underlying market. You've got to remember that the euro market is much bigger than the UK market. Now, you could argue that the US market is much bigger than the UK market, so maybe dollar LIBOR could have been retained. The problem with that is dollar LIBOR is not owned by the US. LIBOR is regulated by the FCA.
Understood. Yeah.
And the FCA said, well, if you want to do your own thing, please go ahead, but we're not going to regulate it anymore, so it has to go.
Understood. Okay.
So the distinction between Euribor and LIBOR is the FCA went, it's going, and you can do whatever you want with your others, but we're not going to regulate LIBOR anymore because we don't deem it to be representative. That's my comment.
No, I think that's probably understood. What was it? What did they do to Euribor that made it? What did they do to remediate it that made it okay?
No, I'd have to go and look at my extensive notes on the subject.
I didn't see.
3 years ago.
I tell you what,
2 or 3 years ago. I think what happened is they put into place. First of all, banks are now joining the Euribor panel, right? So it's much more representative. I think there was 16 banks sometimes there were 8 banks, depending on what currency you're talking to. It was 8 banks that constructed the currency LIBOR. In the case of the bigger ones like sterling and dollars, it was 16 banks. But you still got rid of the 2 highest and 2 lowest, so you got down to 8 banks, 2, 4, 12 banks. But in Euribor, it was already 57, if memory serves me correctly. And I think the other thing that they did was they put into place a much more rigorous waterfall of what would happen if, for any particular reason, market conditions were such that banks couldn't publish their estimate of Euribor. So there was a fallback process put in place. So first of all, it's a bigger market. There are many more contributors, and they put a fallback in place. Understood. So I think that, without checking my exact notes as to what they did, but they remediated it, and it now passed the BMR regulation. Or
that's reasonably clear. Thank you. No, I think some people wouldn't have been aware of that. Please carry on getting onto the bit about you're going to explain the.
I'll get on I like to build up, as you know. Very
welcome.
Okay, so let's go back. So we're considering the difference between a simple 2-year IRS, which is fixed against 3-month LIBOR, or fixed against an RFR. As the overnight rate is fixed daily, we could make daily interest rate payments because we know what today's rate is, and we could make the payment at the end of the day, right? So we should, in fact, make interest payment at the end of the interest period. Just because it's overnight and the LIBOR one is 3 months, we know the rate and we could make a payment. Rather than 90 days, it would be overnight. But do I really want to make 90 odd individual interest payments every quarter as opposed to the one that I used to do every 3 months over the life of a 2-year trade or even longer? Probably not. But that's okay. What I can do is I can roll up the individual payments that I would have made, right, and make one payment at the end of 90 days, paying interest on the rolled up amount.
So compound.
This is what we're commonly known as compounding. Right? And now I have a payment profile that looks like it used to look like. I've got a fixed rate, I have an index, and I pay it in 3 months' time. The only difference is, unlike the 3-month LIBOR, which as you say is set today, so I know exactly how I'm going to pay it in 3 months' time. Because the RFRs are set daily, I do not know. I have little idea as to what I'm going to be paying in 3 months until I actually get there. Although I do have increasing certainty over time as we approach the payment date. And this has caused, some modifications in the market based on, whatever product you're trading to actually shift the observation period 5 days backwards in time from the end of the index period. It can be 5 days. It can be a variety of things. There's a variety of workarounds.
Just explain the observation period for people who may not be familiar with that. So just explain this 5 or 6 day or X day observation period before the start of the.
So if I think of a 2-year IRS that is against an RFR, an overnight index swap, as we would generically call them.
Yeah.
It's a fixed rate against a daily fixing. Now, if I imagine that this is a 3-month payment in 90 days' time, on the 90th day, I would have all my other 89 interest rates amounts plus the last one today, and I can now calculate with absolute certainty the amount I have to pay. The difficulty is I have to pay it today, which obviously in some jurisdictions is just not possible. It is possible in sterling, but it was deemed to be operationally difficult for non-professionals to arrange overnight or same-day payments and to do the calculation based on when the rate came out. And in some jurisdictions, the rate actually doesn't get published until the day after. So today's rate, you don't actually get to know what it is until tomorrow, and yet you're meant to have made a payment today. So the idea was to shift everything back. So whereas the observation period and the interest period are normally locked in sync so that you observe the interest rates over the same as the payment period, we decided that we would shift the observation period 5 days back.
Yeah.
So that, of course, means that when you start a trade, you've already got 5 days worth of fixings, whatever the last 5 days have been, when you think about it. There are some other ones as well, which actually shift it back 90 days. So you actually know at the beginning of the payment period what your payment amount is going to be.
Okay.
Now, that's very strange that does happen, right? But I would stay well alone from them.
That's not in the sterling market, though, is it? Or is it?
No, I have never seen that actually.
Okay.
But it is possible. We did get a question there.
But yes, I'm going to finish our conversations and then go through the questions.
Right. Yeah. So now we have a fixed interest rate swap, which has the same payment profile, whether it's OIS or whether it's against LIBOR. The difference is I do not know the interest amount I'm going to pay, the exact interest amount I'm going to pay, although I have increasing certainty until the day of payment, and therefore it is a backward-looking.
Yeah.
Right, or to use the official term, it is a daily in arrears, daily set compounded in arrears payment is the official term.
So okay, and I think that's clear. That's explained it very clearly. Thank you. So just taking just these two markets, otherwise we'd need it all day. Just sterling markets and US dollar markets. Actually, let's just start with sterling because that's easiest. In sterling markets, if I am paying a 3-month floating rate coupon, either on a loan or on the floating leg of a swap, then the amount paid on the payment date is based on the daily compounding of the rates that have been fixed, the actual fixing, if you like, or the reported, the published rate of the previous, I was about to say 89 days, but actually it's actually a bit before that, because there's the observation period kicks in before the start of the interest payment. Sorry, the interest period. Right?
I think we have to be clear with observation periods, right? In the US, well, okay.
Just stick with sterling for now.
Okay, we'll stick with sterling. Okay, overnight index swaps have already existed. SONIA market existed way back.
Yeah, absolutely.
So SONIA is nothing new to the UK market. The calculation of SONIA, the actual fixing rate, changed a little bit. So to your point, it was remediated. There was a slight tweak to it. However, SONIA market has existed for an awful long time. So it is between professional counterparties. So it is, the professional counterparties grew up with the ability to do daily backward overnight compounding in arrears, and make the payment at T+1. Became standard.
Okay.
So, you know, at the end of the 90-day payment, if you didn't know the rate because it wasn't going to be published tomorrow, you actually made the payment tomorrow, and it was sort of accepted. You know, it's not quite strictly in line with, you know, but the maths was there, and the market got on with it. It's when you try and take that product to a cash-based, such as a loan.
Yeah.
And then you're talking about a different type of counterparty. You may not be talking about a professional market counterparty. You know, you can go the whole scale from, you know, large financial institution down to, you know, small corporates with a borrowing requirement that are now going to pay SONIA on their fixing. And so to make it easier for them to arrange the payment, this idea of a shift was introduced. I haven't haven't got to hand exactly how much of the market has gone to the observational shift.
Is it more a cash market thing than a derivative market thing?
I think it's definitely a cash market thing rather than derivative thing.
Now
you can have two aspects to this. You can either have an observational shift where you shift back in time for the observation of or you can have a payment lag. So the payment lag is you still have the same observational, you still have your observational and your interest payment in sync, but you just make a payment 2 days after the end, as opposed to
now. Okay.
So observational, payment lag, or combination.
And you've observed both in the sterling markets.
Yes, I have.
Okay.
That's cash-based products.
Right, as I thought, because as you said, SONIA. I mean, I remember writing about SONIA swaps. Oh gosh, before 15, 20 odd years, a long time ago. So you're right. The professional markets were used to doing that, where we have observed this this observational shift or the payment lag. It's more to do with cash products to enable the mechanics to work. That's clear. Now, is this more or less, just looking with the eye on the clock, I want to get on to the other question. Is this more or less how it works in the dollar markets, particularly international cross-border US dollar markets for SOFR? So if I've got a SOFR linked product, either derivative, I'm imagining the derivative markets works exactly the same as the SONIA, always derivatives the same. Weren't they Doris?
Let's assume it's right.
Yeah, but for cash markets, it's in cross-border. If I've got a SOFR linked loan, does it work more or less in the same way we've just described?
Yes and no.
Always yes and no.
Always yes and no, because I think the reason I say yes is because yes, you can have observational lags and you can have payment lags, observational shifts, payment lags. But also the US, unlike the UK, offered what they called term SOFR, term SOFR, as a fallback option. So the ARRC, who were the official body in charge of overseeing the LIBOR transition, actually put term SOFR as one of their preferred fallback options for the transition of a LIBOR-based loan to SOFR in the first place. So you've got to bear in mind this is for existing LIBOR-based products. So you've got to transition from, if you've got a LIBOR loan that goes for more than 6 months in the US, dollars is still available. Dollar LIBOR is still available,
yes,
until June.
But look at
it. If you want to transition that from LIBOR to SOFR, term SOFR is one of your options. And it's a recommended option.
Let's think of a non-legacy loan. I'm originating a loan today. You know, it's a floating rate loan. Corporate customer wants a floating rate loan, 5 years, X years, and it's SOFR linked because that's the reference it's linked to. I'm assuming a quarterly coupon. Can the bank, I think I know the answer to this, and I think it's yes, but I want you to confirm for me. Can the bank say, that's fine, we'll give you a 3-month SOFR? This is actually related to the third question in our list. I'll give you a 3-month SOFR linked loan, and at each coupon period, we'll look at the 3-month SOFR rate today, and we can, just like with LIBOR, we know the interest payment that you'll be paying me in 3 months' time. Is that a common product in US dollar markets, cash markets?
Yes.
Great. I thought as much, but I want you to confirm it because the US regulator doesn't frown on using 3-term SOFR, more or less, right? They haven't got a problem with it.
Well, when they put term SOFR in the documentation as the preferred fallback, it didn't exist, right? In the same way that term SONIA didn't exist when they started talking about it. But I think it to answer your question, yes, it's common to have term SOFR, and I think we have to think about where does term SOFR come from? I mean, what is it?
Yes, what is it?
Yes, what is it, right? And I think that's the question you should be asking, right? What is term SOFR as opposed to overnight SOFR? Well, I think it goes. Let's go back to where we were a second ago, right? Because it flows now. I did think about how this was going to flow, right? So it flows a little bit naturally. So we have where we left off a minute ago was talking about you had a LIBOR-based swap and you had an RFR-based swap, or an OAS swap, or whatever you want to call it. Because you compound up and look backwards, okay, it's different. But if you think about the cash flows on a fixed versus floating, whether it's LIBOR or RFR, they're the same. You got fixed rate cash flow and you got quarterly cash flow.
Yeah.
Okay. So knowing today's overnight rate and observing, things that tell me where the overnight rate is going to be in the future, and that could be futures, because SOFR futures exist now.
Yeah.
It could be SOFR interest rate swaps or OASs. I can build a yield curve, right? In the same way I used to build a LIBOR yield curve.
Yeah.
Right? So I now have a OAS yield curve that goes out for as long as the government bond market and longer. And they are observable inputs into that curve.
So the 3-month SOFR comes from that constructed forward curve.
Yes, exactly. So it's a construction. Right?
Yeah.
So I can take a snapshot of that curve at 11 o'clock. And I can tell you where the 2-year rate is, the 1-year rate is, the 9-month, the 6-month, and the 3-month.
Yeah.
So all of a sudden, if I take a snapshot of the derivatives curve
today, yes,
at 11 o'clock today, I can see where today's 3-month SOFR is.
It's a straight interpolation.
I could use that.
Yeah.
I could use that as a input into a swap.
Yeah.
And I set it today. And I do not have a backward-looking trade anymore.
Exactly. Yes.
I have a forward-looking trade. It's a shoe-in for LIBOR.
Yes. Right. Now,
so it beggars the question as to why on earth we go for all this backward, compounded, in arrears nonsense, right? As opposed to just shoeing in, a term rate.
Yeah.
And I think I think if you think about it, it's sort of understandable, because if the term rate itself is dependent on liquidity in the underlying overnight backward in and arrears,
then it's a little bit artificial, isn't it?
Well, it's chicken and egg. If you don't have liquidity in the overnight index swaps, backward, the compounded in arrears, or the backward looking. If you don't have no liquidity in it, then by definition you won't. The snapshot of where you think term SOFR or term SONIA is at 11 o'clock will not be based on any liquidity.
Absolutely understood that.
And
absolutely.
That's the problem.
Yeah,
that's what the regulators didn't like, because that is just inventing LIBOR 02. Right?
Yes, although there's less. I suppose it's less prone to manipulation because I've got a genuine rate. Well, look, I didn't say it was not prone to it. I say it's prone.
Well, if you're going to say, okay, I've got a very liquid overnight fixing,
which we are, let's say that,
and I'm going to build that into an overnight, a forward-looking over. So I'm going to build that into an OIS curve that goes out in the same way that the LIBOR curve is. I need liquidity in those OIS swaps to validate that curve.
I understand what you're saying.
If I bifurcate liquidity between IRSs against overnight and IRSs against 3 months, then I'm shooting myself in the foot when it comes to constructing an OIS curve against the overnight rate with liquidity. And that's what the regulators were scared about, and that's why they said, no, you cannot do derivatives against term.
Okay, now we're going to come to that. Right? We'll come to that. So, from the cash market perspective, I'm a corporate borrower, or I'm a corporate depositor. I mean, from my RBS corporate banking days, large corporates actually quite floating rate deposits, actually. So I'm a corporate, I'm a customer. Whatever product I'm interested in getting from you, a loan or a deposit, I want it to be linked to floating. You're going to link it to 3-month SOFR if it's dollars or SONIA. I use the word artificial. We can use the word constructed if you like. We have a constructed 3-month from the let's use the word genuine. The overnight rate is based on actual transactions, so there is liquidity behind it, dollar or sterling, and so the overnight rate we're reasonably happy with. It's hardly prone to. It's very unlikely to be prone to manipulation because it's based on actual transactions. I've got a genuine overnight. I use the word artificial. I imply a 3-month based on that overnight rate through my yield curve model, and I get a 3-month quote, right? Which is
it's different from a yield curve model. The 3-month rate, the 3-month OIS swap, right, actually trades. It trades in good size.
Yes.
So I can ring up and say,
no, I understand.
Give me what is your 3-month against overnight in arrears?
Absolutely, I understand that. But the coupon on the swap is linked to the overnight rate, right? It doesn't pay a 3-month SONIA. Exactly. No. Right. That's what I'm.
No. I'm stopping you there. The coupon on the swap is determined by supply and demand.
No, I meant.
So if I think
calculation, the 3-month rate, isn't that based on the overnight in arrears daily accrual, isn't it? The coupon.
No, it's not. It's today's expectation of where those overnight in arrears are going to end up.
No, I don't mean the fixed rate side of it.
Okay, I mean the fixed rate.
Right, yes, let's be clear. Very glad you put me.
So it's it's the fixed rate that I publish every day.
Now, I think most people, I'm about to say we, but I can't speak for all the people on this call. Most people are reasonably happy with the fixed rate leg of the SONIA swap in the same way we are reasonably happy with the fixed rate leg of the LIBOR swap. Okay, so we're reasonably happy with that. We see the liquidity. They trade in, as you said, trillions. Well, certainly in dollars anyway. Actually possibly in sterling as well. We're happy with that. The actual floating leg coupon payment is calculated in arrears, as you've just described. And on the day of the coupon payment, I know what it is because I've calculated it in arrears. Just leave aside any observation. And that's a payment based on actual rates that I have confidence in. It reflects liquidity. A quoted 3-month RFR rate is based on taking the overnight rate and essentially, implying a 3-month. Because you said, where does it come from? What is 3-month SOFR? What is 3-month SONIA? I've kind of implied it, haven't I? Or I use the word extrapolation, but if you don't like that word, we don't have to use it.
Maybe I'm not explaining this very well. Okay, so you just described that the current observable 3-month SONIA swap or SOFR swap, right, is a fixed rate against the compounded overnight. So if I transact that, I'll be paying whatever the fixed rate is, and eventually in 90 days, I will receive a coupon.
So far, so good.
Okay, so far so good. But that swap trades on a daily basis.
Yeah, understood that as well.
Yeah. Okay. All right. So it trades. So therefore, it is a market observable trade.
Yes.
And if lots and lots and lots of volume goes through in that 3-month trade on a daily basis, you could just snapshot where that rate is
Gotcha.
at
So
11 o'clock
gotcha.
and use it as a forward-looking rate.
Right, understood. I'm with you 100%.
That's what it is.
Now, so therefore,
so not two different things.
30s, no, I understand. Understood, perfectly clear. The 10-second answer to the question, because you asked it yourself, what is the 3-month SOFR? What is the 3-month SONIA? What is it? You've just answered it, I think. Where does it come from? It's by observing the derivative market for OIS swaps and observing the equivalent of a 3-month rate. Yes? Where does the 3-month SONIA come from? It comes from observation. And so when I see, if I look at King & Shackson bond brokers and I see their daily money market space, they've got a 3-month SONIA quote. Okay? Where have they got that from? From what you've just described, right?
Okay. So as previously as a market maker in these products, I can tell you that I will make a two-way price in anything from 1 week. Well, in fact, we'll probably do Tom next, Sonia, but that's just ridiculous, right? I'd make you a two-way market in 1 week, 2 weeks, 3 weeks, 4 weeks, 1 month, 2 months, 3 months, 6 months, 9, out to, let's say, out to, I would do it out to 5 years, right? Okay. But anyway, so I'll make you a two-way price, and lots of other banks will as well, right? And so therefore there is a considerable amount of market making activity and therefore liquidity, right, observable in both the SOFR and the SONIA market. And that can be, as long as that liquidity is there, right, then I should, as a regulator, have confidence in saying, okay, well, if NatWest and RBS and Barclays and HSBC and Paribas and all these banks are willing to say at 11 o'clock, I will quote 21.19 as the 3-month SONIA, then I will take a snapshot.
Understood.
And 20
That's clear. So it's actually a genuine market. It's a genuine market rate.
Genuine market.
Supply and demand.
But that's my point about the regulators want all the liquidity in that market because they do not want a bifurcated market where the interbank market sometimes trades against overnight and sometimes trades against term, because that means that the amount of liquidity in the OAS or the overnight version is being diminished, and therefore it demeans the robustness of the 3-month snapshot itself.
Okay, right? I'm hoping that's clear for everyone. Now we've got to allow time for questions. We've got a lot here. I'm going to go. We did answer. Went straight to question 3. Question 2. You've got essentially 2 or 3 minutes with your market making hat on. I want to hedge, and it was I do a lot of fixed rate lending. Okay, as a bank. Actually, not with your market making hat on. Put your market making
ALM
customer. Yes, put your ALM hat on. Yes, you're the customer. You're your customer. Your bank customer, interbank customer. I do a lot of fixed rate lending. I do a lot of fixed rate deposit taking. But let's just concentrate on fixed rate. I do a lot of fixed rate lending. I want to hedge that. I'm in the sterling or the dollar market. I do 5-year fixed rate lending. I want to hedge that. What I've previously done. I'm paying fixed on the 5-year. Let's say I had only one loan on the balance sheet. X million pounds. I'm receiving fixed on that loan because I've lent fixed rate. So I'm going to go to the swap market, match the notionals or match the interest rate sensitivity, and pay fixed to receive floating in the swap. Okay, that's what I would have always done the last, I don't know, nearly 40 years now, right? Early 80s, mid 80s, something like that.
I said 80s.
80s. See, you and I could have a good conversation about music from the 80s, Kevin. I don't know if you know out there, guys. We're both Smiths fans, but I don't know if he wanted you to know that, right? So that was always the case. That doesn't change. The only difference is now the swap is I'm going to be paying fixed to receive floating, which is now a quarterly paying SONIA or SOFR linked swap, right? That's still the hedge, right? My question to you is, as per the blurb on the webinar, the marketing for this webinar today, Is there any nuance to that I need to be aware of? The hedge is the same. I'm receiving fixed on the loan, so I pay fixed on the swap to receive floating on the swap. Previously, it was 3-month LIBOR linked. Now it's a 3-month coupon, quarterly paying coupon, dollars or sterling, but they're linked to these two references that we've just been talking about. You've got literally 2 minutes to explain then any nuances that you would add to what I've just described for my hedging transaction.
Well, okay, well, first of all, I say if you have a fixed rate asset, how are you funding it? So from an ALM perspective, I'm thinking the fixed rate asset, you need a fixed rate liability, then you don't need to do any hedging. To the extent that you don't, you have a mismatch.
Yes, because it's floating rate funding.
To the extent that historically you swapped everything back to 3-month LIBOR, and then you had 3-month LIBOR on both sides of the balance sheet. If you now swap everything back to overnight or SOFR or SONIA, you now have overnight on both sides of the balance sheet. Now, ignoring the fact that it's paid, you compounded and paid quarterly, whatever. One of the strange advantages of a balance sheet that is constructed against SOFR or SONIA on both sides, as opposed to one that is constructed against LIBOR on both sides. You never quite tie up your LIBOR fixing dates on your assets and liabilities, so you have massive fixing risk.
Yeah.
All that goes away. It nets to zero because you've got $1 billion of assets against today's overnight, and $1 billion of liabilities on $1 billion balance sheet, right? So they all net out to zero. Now, obviously, it's not that simple, but it is. Netting of fixing risk is one of the advantages of moving to OIS, right?
Okay.
There are other advantages, probably not for this conversation, but discounting rate advantages. You lose the credit sensitivity that's inbuilt in LIBOR, that goes away.
Yeah.
So I've always thought that when it comes to credit spreads, if I'm a borrower and I go to the bank and I say, can I have some money, please? And they say, yeah, you can pay. It's 3-month LIBOR plus 100. I'm paying 100 over LIBOR. Okay, fine. Maybe that's what I had in my mind. I'm paying a spread of 100. But in reality, I'm paying 100 over an average bank credit spread. So I'm paying the bank credit spread as well. Now, with SOFR especially, because it's secured, that goes away. So I'm not paying the bank's credit spread. So the bank will no longer lend me at SOFR plus, well, it won't lend me at SOFR plus 100. It's probably closer to SOFR plus 125. Then things have a strange way of normalizing, and they probably will lend you at SONIA plus SOFR plus 100. But in theory, it should be SOFR plus 125 to make up for the extra credit spread that's disappeared. But again, that's another nuance, if you want. There are no credit spreads in SOFR.
Yeah. Now, I saw on the chat.
You're not worried about what we used to call the fear index of LIBOR versus OIS. When there were bank funding crisis, the official Fed rate was getting cut, and LIBOR was going up.
Yes.
Right. So another reason for the regulators looking at the impact of LIBOR and the transmission of monetary policy, they're saying, I'm cutting rates left, right, and centre, and all I can see is interbank rates going up. Right? Yes. So this gets rid of that.
Yes. Now I want to address these questions that our delegates have kindly posted for us. But thank you for that, Kevin. I think for me, very helpful for me personally on the hedge question. It's the same process, and the one benefit is I'm closer. I've removed some of that fixing risk or the mismatch in date setting by having everything on the overnight. Or the backward-looking in arrears compounding has immunized both sides of the balance sheet better for me. Yes, and so absolutely. So we've got the hedge process more or less the same. In fact, it's probably made it a little bit neater. On the cash side, we've just had a good conversation about linking it to the term SOFR or SONIA. And regulators don't have a problem if the term SOFR is quoted between the bank and a customer. And we had a good conversation about where the 3-month actually comes from. Okay, so thanks very much for that. These things always last longer than one is actually scheduled for, or one needs longer. Let's have a go through with some of these questions. So appreciate that. First of all, I can take the first one, Kevin. Wasn't there a LIBOR scandal? Yes, there was. There was a LIBOR scandal. Many billions of fines levied to large market-making banks around the world, and one or two people I personally knew one of them actually. When I met him, he was the grad trainee at Barclays, and 10 years later he was running their swap book. He ended up in jail, but apparently there's been some unwinding of that. Now, there was a lot of scandal on that, led to the change in elimination of LIBOR. Now, let's get the first question from Luca Restagno. I hope I pronounced it right. Is it right to say that if I had a LIBOR 3-month paying quarterly and it transitioned to a SONIA 3-month compounded, the repricing moved effectively from 90 days to 1 day, as each interest rate change would be immediately passed? Is the short answer to that yes, Kevin?
You're going to have to repeat the question.
Sorry, can you say? Oh, I thought of you reading.
Repeat the question.
Do you have the chat in front of you?
I haven't got it.
Oh, okay.
I have the chat. I have the chat, but
go to the one from Luke.
There's a whole series in them.
Yes, go to the. If you go to the top, it says the one after.
Is it right to say that if I had a LIBOR 3-month paying quarterly and it transitioned to a SONIA 3-month compounding, the reprice move effective from 90 days, which means? Well, I mean, if you're saying that, okay, so if again, think about the two things side by side. If I had a dollar swap where I was receiving or paying fixed, it doesn't matter. But and on the other side, I have 3-month LIBOR. I'm either receiving or paying. It's set today, and I know in 90 days what I'm going to pay. It doesn't matter if the Fed puts rates up 300 million basis points, right? I know what I'm going to pay. Yes, if your question is on the other side, does the day-to-day rate vary as rates change? Yes, it does.
Okay.
Now, you can view that as a positive or a negative. Cuts get passed on much more quickly if that suits you, or hikes if it suits you. Depends which way round you are. But yes.
Okay.
That's another reason for having a balance sheet that's immunized on both sides.
Yes.
Because you don't care.
Absolutely. And by the way, the very, very, very pertinent point you made at the end, if I did fixed rate lending and I matched it with fixed rate funding, then I wouldn't have to go to the swap market anyway. But of course, banks don't generally do that. Okay, thank you for that. Now, next one. Can you explain the difference? I think we did this actually. Can you explain the difference between look back with observation shift and without observation shift? I think you explained that quite clearly. So Raj, if you still had a question on that, perhaps we might get time to answer that one. From Joris Moulin, is it fair to say that term SOFR equals US dollar OIS? What do you think of that? No,
I think we have to be careful with terminology, right?
Yeah, we do.
OIS is overnight index swap. It's a generic term, which can underneath that can come SOFR, SONIA, Fed funds swaps.
Yeah, absolutely.
Ester swaps, the Ionia swaps, yeah, everything. So overnight index swap is a generic term. Dollar OIS, again, you're being more specific here, and you're talking about either SOFR or Fed funds, or there may even be something out there I don't know about, Emeribor maybe, or something like that.
Yes, yes.
Term SOFR is different, as we I think we went to pains to say. Term SOFR, today's term SOFR, 3-month term SOFR is, where is the 3-month SOFR swap market trading
today?
11 o'clock.
Yeah, and let's
take a snapshot.
It's a direct market. Yeah, absolutely. That's fine. Thank you for that. But if a term SOFR is used, do we have a curve to do the forward estimation and discounting using term SOFR? This is from isn't that short answer? To that is yes. Isn't it? I just get the SOFR curve, the SOFR swaps curve, and I use that to do my discounting, right?
No. Okay, that's a bit technical. Right? It's another advantage.
You've got 1 minute, Kevin.
Okay, well, it's another advantage, because if I have a swap against 3-month term SOFR, right, I have to project what that 3-month term SOFR is going to be at over the next fixings, right?
Yeah.
Because by definition, 3-month term SOFR is where the 3-month SOFR is trading today, then 3/6 term SOFR, if you want, is the implied forward between 6-month SOFR, today's 6-month SOFR, and today's 3-month SOFR.
Yeah.
So it's already built in the curve. So therefore, I use the same curve, the overnight base curve.
Yes, isn't that what I said?
Right? There is. Well, I thought someone said, would I use a term SOFR curve? No, there is no difference between the two.
Okay.
Term SOFR curve, OIS curve, exactly the same.
Yeah. No, that's what I thought.
Might run into a slight problem on supply and demand, because what we're really saying is there is no term basis. There is no term premium
between the overnight and the 3-month.
Yes.
Right.
Now, we always used to think there was no term premium between 6-month dollar LIBOR and 3-month dollar LIBOR, and that obviously proved to be wrong.
Yes.
Because there was a term premium.
Definitely.
There is not a mathematical term premium in the spread between the OIS curve and the 3-month curve, right? There's no mathematical spread.
There isn't,
but
although,
if the whole market is one way, there will be one.
yes. We need to reschedule a part 2 for this one, Kevin, because I want to talk about, I think there naturally has to be one in real terms, not mathematical terms, because there's a term premium between 3 months and 6 months ordinarily. But let's leave that for now. But I agree.
But not in OISs.
We need part 2. Right. Thank you for that, everybody. Next comment from Turkey Al-Halwas. Sorry, forgive me for pronouncing incorrectly. If overnight is based on real transactions, what about other tenors? But again, we've answered that for 3 months, haven't we? Based on real transactions, right?
Well, we've said the 3-month rate is based on where the 3-month swap is trading.
Yeah, absolutely. So the short answer
is, and if the question is why did they select overnight? Because it's because there's more transactions in the overnight than there is in any other tenor.
Yes, and you said that at the start, absolutely, and there is, correct, in both dollars and sterling, and I dare say in just about any currency, really. What about credit spreads? Now, I think you did talk about the removal of that credit spread, which is something the regulator wanted to see. So I think we've addressed that from David Cartella. Thank you. Hello, chaps. How much overnight OIS is actually traded?
Mr. Varillo asking a pointed question.
Well, isn't it many trillions?
I'm not sure what he means by overnight OIS. Does he mean overnight OIS swaps?
I think
how much is traded in the market?
Yes, I thought it was overnight. I thought you meant SONIA and SOFR swaps actually traded in the market. I thought that's a very large number, is it not?
I think. I mean, if you look at the volume of transactions that make up the SOFR fixing, it's very large.
Yeah, I thought as much. Okay, now listen. Everybody, thank you very much for your attention and your questions. I hope this has been helpful. I've certainly enjoyed the conversation. Kevin, actually, I have a hand raised. Babu, did you have precisely 30 seconds, sir, if you did want to say anything? There's a raised hand. No?
Moorad. So it was an insightful session. Thanks, both of you. And unfortunately, I joined late to the session, so I'm not sure whether any slides would be shared on the session.
No, this has been a straight conversation. There's no slides on this one. It's a straight conversation.
I could see the recording in progress as well. Any recording can be shared?
Yes, our BTRM admin will send out the recording in due course for everyone who is on this call or indeed registered for it. I think that's all the questions. So timed to perfection, if I say so myself. First of all, my thanks to Kevin. Really appreciate your time and your insight. Very useful, very valuable. You can see from the comments that we had that it's got a lot of people thinking about this. My thanks to you, everyone. Thank you for joining us. To Babu's question, the recording should be made available to all of you, certainly. If not, please send a message to your BTRM admin. And my thanks to you generally for joining. Hope you enjoyed the conversation. I will see you again soon. Kevin, I will see you again soon as well, sir. Thank you again, and good afternoon to all of you. Take care. All the best.
Okay. Thank you.